Duff Phelps is the leading global independent valuation advisor. We have 5,000 professionals working in over 30 countries. Duff Phelps has been around for about, I would say, 100 years now, helping clients in valuations, cybersecurity, real estate, restructuring, transfer pricing, compliance advice, and so on. You may have seen recently in the media that we are actually going through a branding change to bring all of the Duff Phelps businesses together under the Kroll brand. Unifying under the Kroll name, we hope, is going to allow us to represent the full suite of services we provide to our clients and a cohesive approach to delivering solutions to the market under that one Kroll name. For myself, I've spent nearly 30 years in investment banks in London and in New York. I've set up a global independent valuation team at Barclays Investment Bank, and also spent time there as a deputy COO dealing with regulatory change. I've had a few years as an independent consultant, and then joined Duff Phelps about 18 months ago now in valuation advisory practice. Well, it's been a very, very busy first quarter of 2021. So let me see if I can just pick out some of the highlights. Several key pieces of liable transition have fallen into place. In January, we had the ISDA transition protocol for derivatives went live. There's been a great uptake of that from derivative counterparties, and the clearinghouses have also issued their guidance on how clear derivatives are going to transition. We've also seen a lot of guidance come out from industry bodies on the transition of cash products like loans and bonds, which was an area I think something we've been waiting for. So again, a lot more information about how to do the transition. And we're also seeing market data. So the risk-free rates are being published. We're also seeing transition spread values are being published, and the beginning of some of the forward rates of the risk-free rates are also now being published, albeit in sort of test form. Amongst all that, we've seen increasing volumes in the products underpinning the risk-free rates. I think that's been caused by two things. One, there's some changes to the way that the rates are being quoted, so that the risk-free rate is now the primary quotation rate. And also, obviously, just the uptick in demand as people are starting to issue new products using SONIA and SOFA and so on. That's obviously driving demand for the products. So we're seeing more liquidity, more depth in those markets, which is just serving to make the risk-free rates themselves more robust. Although that said, we have seen in the US that they've deferred the term rate publication of SOFA term rates. But in some respects, that's good because it removes some of the sort of uncertainty around how you should transition in US dollar positions. But of course, the big announcement in Q1 was the actual cessation of LIBOR will happen on December 31st for most products, most currencies. Dollar being the exception, although even for dollars, I think the expectation is that new LIBOR referenced issuance will cease from December 31st, although the rate will carry on until 2023. I think that's obviously the big one. That's really taken away any possibility of a delay. I think a lot of people, particularly over the last year during the COVID crisis, have been thinking that perhaps that we're in extension. But I think that, we've had this announcement now. No, December 31st, 2021 is the end of LIBOR. And that's allowed a lot of people to change their focus, plan with a firm date, and actually start to focus on some of the interim milestones that have been set out by the working groups. One of which, for example, was the cessation of LIBOR issued loans at the end of March for sterling products. Well, I think, with the confirmation of the December end date, it's pretty clear that the clock is ticking. It's very important that firms don't underestimate the amount of effort required to execute this transition. I've heard it described as one of the largest regulatory-driven changes ever. I'm not sure if that's true or not, but certainly, it's a lot of people are looking at it in that way. And when you think about the number of individual contracts, products, systems, processes, and companies that are involved in the process, you can see why people are looking at it like that. You've got to remember, LIBOR has been around for 40 years and has worked its way into every little nook and cranny of the business. Outside of the obvious areas of derivatives, loans, and bonds, we've seen intergroup transfer agreements using LIBOR as a reference rate. We've seen procurement contracts that use LIBOR-based penalty clauses. We've seen performance contracts use LIBOR as the benchmark for asset portfolio performance. So it's not just your trading book and your banking book, it's much wider than that. And so when you start to think about the potential breadth of the transition, as well as the depth in terms of the size of some of the portfolios, suddenly 9 months just doesn't seem all that long to get everything done, especially when you think a lot of it's going to require negotiation. And also for a lot of firms, they will have things like code freezes in December, which means that any operational or system changes are going to have to be completed in even sooner than that. So, you're practically speaking, you're perhaps only looking at 8 months to actually complete the whole transition. Get started. I think at the very least, when we talk to clients, we're saying that the very least thing you need to do is at least look at your contracts, get an inventory of the contracts to identify ones that reference LIBOR. That is the only practical way to get a feel for the size of the problem. Just because a contract references LIBOR doesn't mean it needs to be transitioned. Particularly recent contracts may already have fallback language in them that mean that it's not necessary. Like I say, derivative contracts, you can adhere to the ISDA protocol if they're applicable, which then essentially means you don't the amount of work is not that great. But without knowing what your population is, it's very hard. So the only way to be sure is do the inventory, review the contracts. That's not as bad as it sounds. Firms like Duff Phelps have AI-based tools that can automate a lot of that review. We can search through vast amounts of documents very rapidly, looking for LIBOR reference rates or reference rates, clauses. So a lot of that can be automated. It can be done relatively quickly and without too much complexity. But once you have that, then you need to look at the actual language that's there. Is it appropriate? Does it work? And so on. And that assessment is going to be very specific for every firm. We've spoken to some firms who will be looking to actually rebook their derivatives rather than use the ISDA protocol simply because it works better for them to have done that. And they've done the analysis and the scenarios to establish that. And the other thing is to think about is also that the work needs to be done to look at the contracts in the context of the portfolio. If you have a simple portfolio like a loan hedged with a swap, differences in the transition method for each of those products can create basis risk that didn't previously exist. It can cause timing differences. It can cause cash flow issues. So, understanding the scope of what you've got to look at is the first step for anybody. And I think that's the advice we're giving to people is just at least start to look and get that inventory of where your exposures are and what you might need to do. That's the best advice I can give to people right now. Yeah, I think as I mentioned earlier, a lot of contracts we've seen will have some form of fallback language associated with LIBOR not being available. The problem we've had with a lot of those, particularly in the older contracts, is that language was written in contemplation of a brief unavailability, not a complete cessation. So the remedies themselves may not be practical in the long term or appropriate for this final cessation of LIBOR. One example we've seen quite commonly is that the contract will continue to use the last published LIBOR rate. That seems to be one that comes up in bonds quite frequently. And so, if you think about what they were thinking about, say it was a bank holiday, LIBOR wasn't published on that particular day, so you use Friday's rate. Not a big deal in that sort of situation. On the other hand, now LIBOR stops and your floating rate bond just became a fixed rate bond, which is a fundamental change to the instrument and fundamental change to the way your portfolio may function. Will break hedging relationships and so on. That's when you're going to start to have potential problems. But I think the one where we potentially look at potential frustration of the contract is more where some of the older contracts have talked, even where they have language, they talk about the idea of being able to poll banks or brokers in the market to effectively compute your own LIBOR based on quotes from the market. again, you can imagine, back in pre-LIBOR cessation, that made sense. It was just a one-off thing, maybe on the odd day or something like that, and so it wasn't a big deal. To try and do that on an ongoing basis, to ask banks to quote on a rate that no longer exists, is almost certainly not going to work. So even where you have these, the contract may just not be possible, and it will fail. If it fails, obviously it will terminate, the payments will change, the cash flow will change, the risks, is all the things that would happen if a contract stops. And I think, that even this is again why it's so important to understand each individual contract you have, because the way that each contract works can potentially be slightly different. And particularly where you've got older contracts, understanding what language you have and how that will work, even if on the face of it looks like you've got a fallback, it may not be one that's practical and therefore will cause a contract to fail. I think with LIBOR, there's a couple of ways where there is a distinct difference between the risk-free rates that are replacing LIBOR and a LIBOR. The first area is that the risk-free rates are arrears setting rates. They look backwards. They reflect the rate that actually occurred over the previous period, whereas LIBOR is a forward-looking rate that reflects the expected rate for the period in the future. That's going to change the way that models compute yield curves. It's going to change the way that you calculate the payments. I think if you look at some of the transition provisions, they're talking about changing the number of days at the end between the date when the rate is set and the time when the payment is actually due. So there's going to change the way you do your valuation. It's going to change the way you do your payments. It's going to change your operational processes. You're going to have to update your systems to reflect all these new ways of doing things. It fundamentally changes the way a lot of that actually works. So, although people look at it and go, it's a rate, an interest rate is an interest rate, the devil is in the detail, and you will have to make serious changes for that. Now, some of those changes you'll have to make anyway if you want to trade the new risk-free rate-based products that are coming out to replace the LIBOR stuff. So it's not just a transition issue; it's a being prepared for the new world issue. But the second difference between the rates is that LIBOR is a credit risky rate. It reflected the interbank credit risk for unsecured, whereas the risk-free rates are risk-free, clear in the name. The credit risk, these are theoretically credit risk-free rates. That means there is a difference. There is a spread between the two. And again, if you read the protocols that have been set out, there are methodologies out there for computing that spread at transition and going forwards. But there's a lot of those will do things like average over time and so on to smooth out data glitches. That means that it's never going to operate exactly the way that LIBOR was going to. That's going to give you slight differences. And one of the other bigger issues you may have there is if, for example, you had I keep mentioning portfolios. If you had a loan and a hedging swap, and the way you calculate the credit spread transition was different on the different products, you could end up creating a basis risk or actually impacting the overall cash flow of the fund. And this is an area where we're advising clients to model the outcomes, to look at it. It's not, this is a cash flow modeling. This is fairly standard stuff. But looking at that under the different transition scenarios, under the different ways in which you can implement the transition across December 31st transition date, is very important for understanding how that's going to work, what the impact will be on your portfolio, your cash flows, and so on. And ultimately, if there's a transfer of value or a value change, that may be something it could potentially lead to litigation at the end if the transition isn't managed correctly. I think we've covered a lot of this in some of the previous ones, but it does bear saying again, if you get to December without adequate or fallback language in your referencing contracts, you run the risk that the contracts will fail. Obviously, the financial legal implications of that will be very much dependent on what the contract is and who it's with and so on. But it will have impact on your valuations, your risk, your cash flows, and can create legal risks, and potentially can create, for people who are regulated, can create regulatory risks. We're seeing that the regulators globally are watching the whole transition very, very closely. They're looking out to make sure people do it properly, but also looking out for conduct issues or any potential client harm. So, if you've lent money to a client and they're looking to you to support them through the transition, if you don't do that right, you don't have the right outreach program, the right communication strategies, and so on, you're putting yourself at risk of regulatory censure as well as potential litigation. I think, as I mentioned, this is a huge regulatory-driven change program. The complexity of the change shouldn't be underestimated. We're talking about making changes to hundreds, if not hundreds of thousands of documents across the world. You need to be looking across your whole firm because it's not just localized in one area. It could be anywhere in your document repository. Those changes will impact valuation models. They will impact payments. They will impact your risk management. They will impact your accounting. They will impact your regulatory capital. And the thing is that to actually make these changes and do them well and have this go as smoothly as possible requires people who really do understand the products and how they work in the upstream and downstream systems. So having a person who understands the valuation piece is great, but that person needs to be talking to someone or have the knowledge of how that impacts the payments, how it impacts the regulatory capital, what that implies for the accounting. And you need to have someone who can oversee that, who can look at it and say, okay, we're doing this with the loans, we're doing this with the bonds, we're doing this with the swaps. How does that come together as a portfolio to impact on the firm as a whole? You're not going to do that by getting somebody in who doesn't know this stuff inside and out, because I think, as I've sort of said, the devil is in the detail for some of this stuff. The changes you're talking about could be relatively small, but because of the number of contracts involved, the size of the notionals involved, that the impact can be very large. So you really do have to understand it at a very fine level to make sure this actually all transitions smoothly. And do not underestimate how big a change that this actually is. I think some people we talk to look at, we're just making putting a little bit of extra language into the contract. It's like, fundamentally, yes, but then the downstream impacts and of that can be really quite large. So it's not losing sight of that and having people who can understand how that's going to flow through the system, all the way down to sort of settlements and accounting and reporting. And I think, again, like I say, one of the other things we say to people now in their planning phase is having people who can model that, who can run simulations or scenarios that do that to make sure that you can anticipate the potential problems before they happen.